Well, good morning. This is Michael Douville coming to you from beautiful Phoenix, Arizona. It's August 29th, 2020, and we want to talk about divergence. We had a lot of calls, again, a lot of confusion. Perhaps I wasn't clear enough on this webinar that we did Tuesday on divergence. Divergence doesn't happen very, very often. It's kind of a phenomenon that we see, and it's a big red flag when we do see it. What happens with divergence is the stock market decouples from the economy, and the two are no longer in sync. And that, of course, is a bad sign because the stock market derives its value supposedly from the fact that they're making money, they're earning incomes, they've got an income stream, and the value of the company keeps going up because they're doing business. Well, of course, we had a complete collapse here in March, and a lot of companies have done well, but a lot of them are still struggling. And a lot of the indexes are really reduced to the S&P 500. There's very, very, very few companies that are doing very well, and people are piling into those companies, and it's distorting the index, which then, of course, distorts the stock markets. So the S&P 500, I've been called as the S&P 5, and of course that's just a funny saying as to the fact that there's very, very few stocks that are doing well. Because keep in mind, it's a market of stocks, and a lot of these stocks are not doing well. And if you just think this through, we have 23 million Americans still out of work, and of course we're a service economy, and if the service economy is not doing well, then of course that's reflected in earnings. So we're starting to get to the point where we're seeing this distortion in the price earnings ratio, and that's reflected, and we have the poster child, I think, in Tesla. Now you may think Tesla is an absolutely incredible company. They've got tremendous technology, they've got great patents, they have a good future, but still they are a company, and it's sold on their performance and their price to earnings. So if they get the earnings go up, why, that should make their company more valuable. However, the PE, like the PE for Ford, has been 6 or 7. Sometimes it gets up as high as 12 or 15. Typically, when you see S&P, the PE ratio is around 15 to 18%. Sometimes it gets distorted, gets up into the low 20s. But Tesla is over 1,000 PE. So obviously something is distorted there. That's a huge, big red flag. Also, the bond market is priced for perfection. Now, I've been hearing studies saying that there's an awful lot of companies that are on life support. They're calling them zombie companies. And the only reason that they're still in business is that they're still borrowing money. And of course, the Federal Reserve is supporting a lot of the bond market. But once that goes away, a lot of these companies are going to go away. So that's just added risk. So not only do you have credit risk, but of course, now you've got interest rate risk because we're at 0% interest rate. So a double whammy for the bond market. So both the stock and the bond market really have risk, and yet they're both at historic highs. So that's diverging from the economy because the economy is probably, the GDP is probably below zero. So obviously something not in sync. When we have divergence like that, you need to just pay attention, talk to your financial advisors, talk to your financial professionals, and see what kind of risk you are taking. What is it that you're taking? What is your portfolio at risk for? I mean, do you have hidden bonds in your bond funds that if the companies can no longer borrow money, are they going to go out of business? In which case, those bonds will go to, they'll get radically changed. They'll probably go to zero. So you just need to know what you have. Now, this is the perfect time when we've had markets that are priced for perfection and probably are overvalued. In my humble opinion, the stock and bond market probably overvalued. This is a great time to take your profits and move them into a different asset class where the cycle is not ending, because I think we're at the end of the cycle for stocks. I think they're still probably at risk, same with the bonds. But real estate is not. Real estate is still mid-cycle, and there's still a lot of room to run. And some of the great markets of the United States, that's Florida, Texas, and Arizona, are doing absolutely amazing. And that trend is going to be a decades-long trend. So it's not something that's only going to be 6 or 9 months. We're talking something that's going to be 5, 10 years long. Great place for you to invest your money. Now, real estate can not only give you a capital gain, but it gives you almost instantaneous cash flow, because we want to get paid. We buy a property, we want that cash flow to start right away. And of course, we have property managers, and you can be a very, very passive. You can be as involved as you want, but it can be a very, very passive investment. And it's just great for foreigners. It's great for people out of state. It's great for pension plans because it just generates income. So this would be a really good time to talk to your advisors, find out what's prudent for you. If you're at all at risk, please give us a call. We're here in Phoenix, one of the great markets of the United States. We are just doing absolutely wonderful. We'd love to get involved with you. We're very, very good at what we do. We're more than happy to talk to you. You can contact me at Creating Wealth at West USA. You can contact me at Michael at michaeldeuville.com. And we're here to help you if you want to call us. We're willing to talk to you at 602-942-4200. My very best to you. Bye-bye now.